Something just happened in the silver market that hasn't occurred in over 4 decades. And if you're not paying attention right now, you're about to miss one of the most significant wealth transfer opportunities of our generation. Let me paint you a picture of what's unfolding. Silver just breached a psychological barrier that traders thought was impenetrable. We're talking about a price level that hasn't been touched since the Hunt brothers tried to corner the entire silver market back in the early 80s. That's right. The white metal just crossed a threshold that an entire generation of investors has never witnessed. But here's what nobody's talking about. This isn't just another commodity rally. This is the beginning of a supply crisis that's been building for years, hidden beneath the surface while everyone was distracted by other markets. And the smart money? They've been positioning themselves for months, quietly accumulating physical metal, while retail investors were chasing the latest tech stocks. Think about this for a second. When was the last time you saw a commodity break through a 45-year resistance level? It doesn't happen by accident. It doesn't happen because of speculation alone. Something fundamental has shifted in the global economy, and silver is screaming a message that most people aren't hearing yet. The industrial demand story is unlike anything we've seen before. Every single solar panel being installed across the globe requires silver. Every electric vehicle rolling off production lines needs significantly more silver than traditional cars. We're talking about a green energy revolution that's consuming silver at a pace that mines simply cannot keep up with. The deficit isn't coming. It's already here. And it's getting worse every single quarter. But let me take you back to understand why this moment is so significant. In the late 70s, 2 brothers from Texas decided they were going to own as much silver as they possibly could. Nelson Bunker Hunt and William Herbert Hunt started accumulating silver when it was trading around $6 an ounce. They didn't just buy futures contracts, they took physical delivery, millions of ounces. They stored it in warehouses. They convinced wealthy investors from around the world to join them, and the price started climbing. By early 1980, silver had rocketed to an all-time high. The Hunt brothers had turned their initial investment into billions of dollars on paper. But here's what happened next. The exchanges changed the rules. They implemented position limits. They raised margin requirements. They made it nearly impossible for the Hunts to maintain their positions. The price collapsed. The brothers went bankrupt. And silver entered a decades-long bear market that convinced an entire generation that precious metals were a losing investment. Fast forward to today, and we're seeing something completely different. This isn't a speculative bubble driven by 2 wealthy individuals trying to corner the market. This is a structural supply deficit meeting unprecedented industrial demand, while central banks around the world are debasing their currencies at a rate that would have been unthinkable just a few years ago. Before we go further, I want to share something with you. I've put together a free guide that breaks down the wealth protection strategies that thousands of American retirees are using right now. It's in the description below. No cost, no obligation. Just practical information that could make a significant difference in how you navigate what's coming. Grab it while it's still available. Now let's talk about what's really driving this move. The supply side of the equation is broken. Silver mining is not like flipping a switch. You can't just decide to produce more silver because the price went up. It takes years to bring new mines online. Exploration, permitting, construction, all of this requires massive capital investment and time. And here's the kicker. Most silver isn't even mined as a primary product. It comes as a byproduct of copper, lead, and zinc mining. So even if silver prices double, it doesn't necessarily incentivize more production. Meanwhile, above-ground inventories have been declining for years. The COMEX warehouses, which are supposed to be the backbone of the paper silver market, have seen registered silver, the metal actually available for delivery, drop to levels that should terrify anyone holding paper contracts. We're talking about a ratio of paper claims to physical metal that's absolutely staggering. Some estimates put it at over 100 paper ounces for every physical ounce available for delivery. Think about what that means. If even a small percentage of contract holders decided they wanted physical delivery instead of cash settlement, the entire system would seize up overnight. It would be like a bank run, except instead of people lining up to withdraw cash, it would be investors demanding the metal they thought they owned. The industrial demand side is even more compelling. Solar panel installations are accelerating globally. Countries are racing to meet climate commitments. China is building solar capacity at a pace that's hard to comprehend. Europe is desperately trying to reduce dependence on Russian energy. The United States is pouring hundreds of billions into green infrastructure, and every single one of these solar panels requires silver for the conductive paste that makes them work. Electric vehicles are another massive demand driver. A traditional internal combustion engine car uses about half an ounce of silver. An electric vehicle uses up to 3 times that amount. Some hybrid vehicles use even more. And we're not talking about a gradual transition. Major automakers have announced plans to go fully electric within the next decade. That's millions of additional ounces of silver demand that didn't exist 5 years ago. But it goes beyond solar and EVs. Silver is essential in 5G infrastructure. It's critical in medical devices. It's used in water purification systems. It's in every smartphone, every computer, every appliance with electronic components. As technology advances and becomes more prevalent in our daily lives, silver consumption increases. And unlike investment demand, which can fluctuate based on sentiment, industrial demand is sticky. Once silver is used in manufacturing, it's gone. It's not coming back to the market. Now let's talk about what's happening in the financial markets that's adding fuel to this fire. Central banks have been on a gold buying spree for years. They've been diversifying away from dollar reserves. But here's what's interesting. While central banks focus on gold, private investors and institutions are increasingly looking at silver as the more explosive opportunity. The gold to silver ratio, which measures how many ounces of silver it takes to buy 1 ounce of gold, has been historically out of whack. For most of human history, that ratio averaged somewhere between 15 to 1 and 30 to 1. Recently, it's been trading well above that historical average, suggesting silver is significantly undervalued relative to gold. When that ratio starts to compress, and it's already beginning to move, the gains in silver can be absolutely explosive. We saw this happen in 2011 when silver briefly touched near its all-time high. The ratio compressed rapidly, and silver outperformed gold by a massive margin over a short period. Many analysts believe we're setting up for a similar move, except this time the fundamental backdrop is even stronger. The geopolitical situation is adding another layer of complexity. We're living in a world where trust in institutions is eroding. Faith in fiat currencies is being questioned. Countries are exploring alternatives to the dollar-dominated financial system. The BRICS nations are discussing commodity-backed trade settlements. Russia and China have been accumulating gold reserves at unprecedented rates. And while gold gets most of the attention in these discussions, silver is quietly playing a crucial role as well. Think about what happens when countries start settling trade in commodities instead of dollars. Think about what happens when the petrodollar system that's been in place for 50 years starts to crack. The demand for hard assets, for things that have intrinsic value and can't be printed into existence, is going to surge. And silver, with its dual role as both an industrial metal and a monetary metal, sits in a unique position to benefit from both trends simultaneously. Here's something most people don't realize. The amount of investment-grade silver available in the world is actually quite small. If you took all the silver held in ETFs, all the silver coins and bars held by private investors, all the silver in COMEX warehouses, you're talking about a market that's a fraction of the size of the gold market. And it's tiny compared to other asset classes. The entire above-ground investment silver market is worth less than the market cap of many individual tech companies. What that means is that when capital starts flowing into silver, the price impact is magnified. You don't need massive institutional flows to move the silver market significantly. A relatively small amount of money, by institutional standards, can create substantial price movements. And we're starting to see the early signs of that capital flow beginning. Retail investors have been buying physical silver at record rates. Coin dealers are reporting shortages. Premiums over spot price have been elevated for months. Online bullion dealers are struggling to keep popular products in stock. This is grassroots demand from individuals who are looking at the economic landscape and deciding they want to own something tangible, something that can't be devalued by a central bank decision or a government policy change. But it's not just retail. Institutional interest is growing. Hedge funds are taking positions. Family offices are allocating capital. Sophisticated investors who manage billions of dollars are looking at the supply-demand fundamentals and reaching the same conclusion. Silver is setting up for a move that could dwarf what we saw in previous bull markets. Now, I want to address something important for those of you who are thinking about retirement security and wealth preservation. The traditional 60-40 portfolio of stocks and bonds that financial advisors have recommended for decades is facing challenges it's never encountered before. We're in an environment where both stocks and bonds can decline simultaneously, where inflation can erode purchasing power faster than traditional investments can grow, where geopolitical risks can materialize overnight and crater markets before you have time to react. This is why more and more retirees are looking at alternative ways to protect their wealth. And one of the most effective strategies is diversifying into physical precious metals within a retirement account structure. If you're sitting on $100,000 or more in retirement savings, there are ways to get exposure to physical gold and silver while maintaining the tax advantages of your IRA or 401k. I've put together a comprehensive guide that walks through exactly how this works, the rules you need to know, and the potential benefits for your specific situation. It's in the description. No pressure, no sales pitch. Just information that could be valuable as you think about protecting what you've spent a lifetime building. Let me get back to what's happening in the silver market right now and why this moment is so critical. We're at a technical inflection point. The chart is showing a breakout from a multi-decade consolidation pattern. For those who follow technical analysis, this is the kind of setup that traders dream about. A long base, a clear breakout, and fundamental drivers that support continued upside momentum. But more importantly than the technical picture, we're seeing a shift in market psychology. For years, precious metals were dismissed as relics. Investors were told that in a digital age, gold and silver were irrelevant, that cryptocurrencies would replace them, that central banks had everything under control and inflation was dead. All of those narratives are being challenged now. And as those narratives break down, capital is going to flow back into the assets that have preserved wealth for thousands of years. The cryptocurrency comparison is interesting. Many people who bought Bitcoin and other digital assets did so because they didn't trust fiat currencies. They wanted something outside the traditional financial system. They wanted an asset that couldn't be inflated away. Those are all valid concerns. But here's the difference. Silver has 5,000 years of history as money. It has industrial applications that create constant demand. It's a physical asset that you can hold in your hand. It doesn't depend on electricity or internet connectivity or the continued functioning of a blockchain network. I'm not saying cryptocurrencies don't have a place in a diversified portfolio, but I am saying that silver offers something different, something that's proven itself across empires and economic systems and technological revolutions. And in times of real crisis, when systems break down and trust evaporates, physical assets have a way of reasserting their value in ways that digital assets simply can't match. Let's talk about what could happen next. If the supply deficit continues to widen, and all indications suggest it will, we're going to see increasing stress in the physical market. Premiums will rise. Delivery delays will extend. At some point, the paper market and the physical market are going to diverge significantly. We've already seen glimpses of this during periods of high demand when physical silver was trading at substantial premiums to the spot price quoted on exchanges. When that divergence becomes too large to ignore, one of two things will happen. Either the paper price will have to rise dramatically to reflect physical reality, or the paper market will lose credibility entirely, and physical silver will trade in a separate market at much higher prices. Either scenario is bullish for anyone holding physical metal. The mining sector is another angle worth considering. Silver mining companies have been undervalued for years. Many are trading at valuations that don't reflect the current price environment, let alone what could happen if silver continues to rise. These companies offer leverage to the silver price. When silver moves up 10%, mining stocks can move up 30 or 40% or more. Of course, they also carry more risk. They're subject to operational challenges, management decisions, geopolitical risks in the countries where they operate. But for investors who understand those risks and do their homework, the potential returns can be substantial. There's also the recycling angle that people often overlook. Unlike gold, which is mostly held in vaults and jewelry and can be easily recycled, silver is consumed in industrial applications in ways that make recycling difficult or uneconomical. The amount of silver in a single solar panel or smartphone is so small that the cost of recovering it exceeds its value at current prices. But if silver prices rise significantly, suddenly recycling becomes economically viable. That could add supply to the market. However, it takes time for recycling infrastructure to scale up, and in the meantime, the deficit continues to grow. What about the downside risks? What could derail this thesis? A global recession could temporarily reduce industrial demand. A major mine discovery could add supply, though that would take years to come online. Central banks could somehow restore faith in fiat currencies and convince everyone that inflation is under control, though that seems increasingly unlikely given the debt levels and political pressures they face. A technological breakthrough could reduce silver usage in key applications, though current trends are moving in the opposite direction with silver content in products increasing, not decreasing. The reality is that no investment is without risk, but when you look at the risk-reward profile of silver right now, when you consider the supply-demand fundamentals, the monetary backdrop, the geopolitical environment, the technical setup, it's hard to find another asset class that offers the same potential with the same level of downside protection. Here's what I think is going to surprise people. The move in silver is going to be faster and more violent than most expect. Markets that have been suppressed for long periods tend to overshoot when they finally break out. We saw this with oil in the 2000s. We saw it with housing before the financial crisis. We saw it with tech stocks in the late 90s. When a market that's been ignored suddenly becomes the focus of attention, capital flows in faster than supply can adjust, and prices can move in ways that seem irrational in hindsight, but feel inevitable in the moment. Silver has been ignored for over a decade. An entire generation of investors has never experienced a real silver bull market. They don't know what it looks like when silver goes parabolic. They don't understand the psychology that takes hold when people start to fear they're missing out on a once-in-a-generation opportunity. And when that psychology kicks in, when the headlines start appearing, when your neighbors start talking about silver at dinner parties, that's when the real move happens. But here's the thing. By the time everyone knows about it, by the time it's obvious, most of the gains will already be made. The people who profit the most from these moves are the ones who position themselves early, who do their research, who understand the fundamentals before the crowd catches on. They're the ones who are willing to be contrarian, to buy when others are skeptical, to hold when others are selling. We're at that inflection point right now. Silver just did something it hasn't done in over 40 years. The fundamentals are stronger than they've ever been. The setup is better than anything we saw in previous bull markets. And yet, most investors are still focused elsewhere. They're chasing the latest AI stock or trying to time the next Fed decision or worrying about whether the economy is going to have a soft landing or a hard landing. Meanwhile, silver is quietly setting up for a move that could redefine wealth for those paying attention. This isn't about getting rich quick. This isn't about speculation or gambling. This is about understanding long-term trends, recognizing when fundamentals and technicals align, and positioning yourself accordingly. For those of you who've made it this far, who've stuck with me through this entire analysis, I want to offer you something exclusive. In the description, there's information about a one-on-one educational web conference. No obligation, no pressure, just a chance to sit down with someone who can walk you through your specific situation, answer your questions, and help you understand how precious metals might fit into your overall wealth protection strategy. This is only available to American retirees with at least $100,000 in retirement accounts. If that's you, and you're serious about understanding your options, take advantage of it. The knowledge you gain could be worth far more than any single investment decision. The bottom line is this: silver just broke through a level that held for over 4 decades. The supply-demand fundamentals are the strongest they've been in modern history. Industrial demand is accelerating while supply is constrained. The monetary system is under stress in ways that favor hard assets. And the technical setup suggests we're at the beginning of a major move, not the end. You can choose to ignore this. You can wait for more confirmation. You can tell yourself that you'll get in when it's more obvious, but understand that by the time it's obvious to everyone, the easy money will already be made. The question isn't whether silver is going higher. The question is whether you're going to position yourself to benefit from what's coming, or whether you're going to watch from the sidelines and wish you had acted when you had the chance. This is your moment. This is your opportunity to understand what's happening before the crowd figures it out. Don't let it pass you by.